There seems to be this impression that the government has waived off lakhs of crores of corporate loans, but when the Congress talks of farm loan waivers, then all of a sudden it's a big problem. The comment section in my last two videos, one where I analyzed the Congress manifesto and the second where I compared it to the BJP manifesto, and I leave both the links in the description, is full of people who have commented some or the other version of this. As if the government has told corporates, Ja Simran, ji le apni zindagi. And I don't blame them, because that is exactly how the issue has been marketed by opposition parties to the Indian public. They have routinely tried to give the impression that the government has somehow forgiven the loans of rich industrialists while the poor have suffered, conveniently skipping the fact that there is in fact a very big difference between a bank writing off a loan and a government waiving off a loan. The problem may be that in Hindi both of them get referred to as karz maaf kar diya, the loan is forgiven. But that is factually wrong. Hello and welcome to The Bond Economist, your one-stop destination for professional advice on the economy. My name is Aurodeep Nandi, and today we try to settle the debate that is it the case that the government has indeed forgiven the loans of corporates? As always, if you like this kind of content, do hit subscribe. If you'd like to support me, there's the super thanks button below or there's a buy me a coffee link in the comment section. And let me clarify at the start itself, this is not meant to be a political video. It is not about supporting the BJP or dissing the opposition. And this is not to change your perception on whether you think the government is partial to industrialists or not. That is up to you to think what you think. The only objective here is to clinically clarify the economics behind what's wrong when a politician tells you that a farm loan waiver is the same thing as a corporate loan write-off. And why is it that even when public sector banks have been told to write off these bad debts, it's actually less about favoring corporates and more about rescuing the economy from the brink? So first things first, what on earth is a loan write-off? Say you take a car loan from the bank using your car as a collateral. Tomorrow, let's say you stop paying EMIs. The bank sends you reminders, it sends collection agents to your house. You're like, sorry, I just can't pay you. After a point, the bank has to accept that there's actually no point chasing you. You can't pay back the loan. So it writes it off from its books. This is more of an accounting practice. It says that your loan is a non-performing asset. So earlier the loan was an asset for the bank. It was paying the bank regular EMIs, but now it's a non-performing asset. So what does the bank do? It removes it from the list of its assets. But, and this is the important bit, does that mean that you no longer have to pay back the loan? Does that mean that your loan suddenly disappears in thin air? No. It just means that now the bank can come and seize your collateral, which in this case is your car, or it can sell off your loan to other companies that are in the business of buying these distressed loans at lower prices and then dealing with the collection themselves. You, the borrower, you still have to pay up the loan or give up the car. Now, suppose the government gave you an auto loan waiver, then that would mean that you don't have to pay back the loan anymore and the ownership papers are returned to you. So when we say that corporate loans have been written off, please understand, the corporate is still responsible for paying back the loan. And if it can't, it has to shut shop. And by the way, in any business cycle, there will always be loan write-offs of corporates, of MSMEs, of retail borrowers like you and me. There will always be a percentage of borrowers that won't be able to make money, that will struggle to repay the loan and will have to eventually then shut operations. And then their loans will have to be written off by the banks. But the banks will still have to find a way to get back whatever they can. The borrower is still not off the hook. And also with the banks now declaring it as a non-performing asset, their tax liability also goes down. So it's not one and the same thing as a loan waiver. Now, you can still say that, hey, wait a minute. If a public sector bank, say like SBI, is not able to recover the loan, if SBI makes a loss, doesn't that eventually impact the government and public finances? And how much of these bad corporate loans have actually been recovered? So isn't it still indirectly helping corporates? Fair points. Let's address them. The year is 2007. India is shining so much that you needed sunglasses. The economy was booming, GDP growth at around 8%. India and the US just signed a historic nuclear deal. For the first time in their lives, Indians were experiencing cutting edge mobile phones, were on the verge of surfing internet using 3G speeds. Airports were teeming with low cost airlines. India was waking up to item numbers in movies, scantily clad models in Kingfisher calendars. India had just won the first T20 World Cup against Pakistan, and the era of IPL was about to begin. India was coming of age at a time when the global economy was in great shape and everyone was super optimistic of India's growth story. Companies were borrowing copious amounts of money to expand their operations, to invest in infrastructure, to be part of India's booming story. And banks were bending over backwards to provide credit that corporates were demanding, believing sab changa si. There's in fact a fascinating Netflix series called Bad Boy Billionaires India. And in the series, they talk about how Vijay Mallya, in his heydays, when he was this playboy alcohol baron with a fancy airline, surrounded all the time with models and politicians, essentially just walks into IDBI Tower in South Mumbai, bamboozles these public sector bankers into giving him hundreds of crores of rupees of loan. So much was this mad lending and mad borrowing that India's investment to GDP ratio surged from 28% of GDP in 2003 to a record high of almost 36% of GDP by 2007. Things couldn't get better. Except that 1 year later, the global economy collapsed with the global financial crisis. Commodity prices were elevated, India's growth started to slow, the government found itself ensnared in huge corruption scams, ministers and bureaucrats started getting arrested, Prime Minister Manmohan Singh turned from being a famous economist to an infamous administrator. Ministers and bureaucrats were so spooked with being accused of corruption that they would sit on files and not approve them. Because they had no idea if they approved anything today, even if they were doing it honestly. Who knows? Maybe tomorrow, CAG, CBI, ED would land on them, accusing them of corruption. A new term entered India's economics vocabulary: policy paralysis. No one making any decisions and dirt accumulating on paperwork. India's growth story naturally slowed down to a halt. And as it did, a lot of those loans that the banks had given to corporates in over enthusiasm, or some of them by fraud, started coming under pressure. Because if projects were getting delayed, then promoters couldn't pay back their loans. Sometimes companies had borrowed so much that bankers had more skin in the game than the promoters. And also because at that time we had such a miserable system of debt recovery, promoters also knew that they could get away easily. It was like the economic equivalent of jo ukharna hai ukhar lo. So if the promoter had borrowed a lot of money from several banks, it became the headache of the banks to get back the loan rather than the promoter's headache to repay back. And public sector banks were afraid that if they wrote off the loans, kya pata, tomorrow even they may get arrested by various agencies. So they did something known as evergreening of loans. That is, we know you are not paying back the original loan, but then I as a bank can't afford to show it as a non-performing asset in my books. So I will give you an additional loan to allow you to pay the current one, like recycling of loans. But if banks were busy giving loans to people who weren't paying back, to these zombie entities that were no longer contributing to the economy, it also meant that they were not lending to the genuine corporates and people in the economy who wanted a new bank loan to get stuff done. And because banks had so many bad loans in their books from corporates, they were now extremely suspicious of lending to anyone new. And I mean, what happens when fresh credit dries up in the economy? Well, growth stalls. But officially, because banks were not terming these loans as non-performing assets, their balance sheets looked very healthy in theory, in paper. And that was the time when the then RBI governor, Raghuram Rajan, figured that this wasn't going to work. And look, I know that Raghuram Rajan gets a lot of hate, especially after he's come across as partial to Rahul Gandhi's cause. In fact, my previous video on why he could be wrong on his prescription for the Indian economy has been one of my most watched videos so far. But we have to be fair. You may disagree or dislike Raghuram Rajan, but the fact is that he did not cause the NPA crisis. He simply told banks that, hey, you can't keep hiding these bad loans from your balance sheet forever. This is not done. I, as the RBI, am forcing you to bring these out in the open. You can't evergreen these loans forever. Because the first step to solving a problem is recognizing that there is one and figuring out how big that problem is. So when banks were forced to bring their skeletons out of the cupboard, the share of gross non-performing assets in the system soared from around 3 to 4% to around 11% of total loans. So now that the problem was there for everyone to see, the next step was how can the government and the RBI resolve this issue? Now there were multiple fires to douse. First, if banks were writing off all these loans, then it would mean that their capital was getting eroded. What does this mean? Well, bank capital is like an insurance amount that banks are required to keep by regulation as contingency in case people are not able to pay back loans. Essentially, it's the difference between the bank's total assets, which are the loans it's giving out, and the bank's liabilities. That is mostly the deposits it has taken from the public. The yellow bit at the bottom is the capital of a bank. What the RBI demands that it keep on its balance sheet to protect from any loss on the asset side. So if the RBI say that keep 10% of your assets as capital, it means that for every 1,000 rupees of loan that a bank lends out, it is compulsory for them to keep 100 rupees as capital. So far so good. Now suppose of the 1,000 rupees of loans, someone who has borrowed 20 rupees has defaulted. That 20 rupees is the bank's loss. So it gets erased out of the assets. It also gets erased out of the capital. So now instead of 100 rupees of capital that the bank originally had, it now only has 100 minus 20 or 80 rupees of capital. But wait a second. RBI has also told you that your capital to asset ratio has to be 10%, which means that if you have 80 rupees of capital, you are only allowed to lend 800 rupees because 80 rupees is 10% of 800 rupees. But your loan book is 1000 minus 20, 980 rupees. So you're allowed to lend only 800 rupees, but your loan book is 980 rupees. So two things can happen. Either you have to cut down your loan book, which essentially means that you can't give out any more loans to anyone. So you can imagine if all major public sector banks did this, what would be the impact to the economy? It would simply get choked with no credit. Or the second option, you go back to your shareholders and tell them, look, I need you to put more capital in the bank to raise it back to the minimum 100 rupees. Well, technically 98 rupees because 10% of 980 rupees is 98 rupees. And in the case of public sector banks, the biggest shareholder is the government. And so to save the economy, that's exactly what the government did. It helped banks raise back their capital or recapitalized public sector banks. Some of it came from the central government budget, but a lot of it was engineered in such a way that the fiscal deficit wouldn't increase by that much and banks could also find capital from elsewhere. So you may argue, isn't this indirectly the government paying for the sins of corporates and banks? Well, yeah. But if it didn't do this, our financial system would have been hit. Our economy would have been stuck in a deep downturn. But this is one side of the story. What about recovering the loans that had been written off. Now, as I mentioned earlier, India didn't have good systems in place to recover bad loans. And that's why banks suffered while promoters had it easy. So, to recover the loans being written off, the government had to first strengthen the system, the regulatory infrastructure, reform the law, set up the right institutions, create an ecosystem of insolvency professionals, streamline the judiciary, bring in a culture of accountability. So, it was not going to happen overnight. And it was and actually continues to remain an uphill task. But to the government's and the RBI's credit, they've managed to get their act together. Willful defaulters are now on their watch list. The Insolvency and Bankruptcy Code was introduced in 2016. Existing laws and systems have been reformed. The government has set up a bad bank or the National Asset Reconstruction Company Limited with the aim of acquiring bad assets from banks, thereby making their balance sheets healthy again. As we speak, the RBI has become a much tougher regulator of banks and NBFCs than it was 20 years back. The government has said that of the around 10.5 lakh crore rupees that was written off, banks have recovered over 7 lakh crore rupees in the last 5 years. And look, the system is not perfect. There are a lot of legalities, a lot of loopholes involved, a lot of processes are being reformed as and when stakeholders are realizing that something isn't working out. So this is going to remain work in progress. But what is immensely important is that in this process, banks' non-performing assets have come off sharply from around 11% of total loans to around 3% currently. And that corporates too have deleveraged and cut down their debt levels. And so currently, balance sheets of both banks and corporates are the healthiest they've been in decades. Which means if conditions are right, they have the space to expand and restart the private investment engine. So no, it's not as simple as the way opposition parties are marketing it, that the government has magically forgiven loans of industrialists. In hindsight, the real crime happened back in the heydays of 2004 to 2008 when promoters, banks, regulators and the political class were in a state of collective bliss despite rising debt levels and poor due diligence. Since then and continuing even now, it has all been about cleaning up that mess and ensuring that the banking crisis doesn't turn into an economic crisis. For more such insights, like, share and subscribe to The Bond Economist.